Hey, very pleased to welcome back to the show Lance Roberts, Chief Editor of the Real Investment Report and of Clarity Financial. Lance, first of all, very pleased to have you back here with us. There's no shortage of things to talk about, but if you don't mind, I've got to start with the Federal Reserve. Yeah, we are anticipating the rate rise on Wednesday, but what else did you make of that?
Well, you know, the interesting thing is not the fact that they were going to raise rates. It was really what their forecasts were going to be for the continuation of further rate hikes going into the rest of this year. What was interesting is the market misunderstood what they actually said. The market took it on Wednesday as, oh, they're very excited about the economy and economic growth, and they ran stocks up into the close on Wednesday. On Thursday morning, they went back and looked at what the Fed said, and it wasn't nearly as dovish as they thought. In fact, it was actually more hawkish, and of course, that's why stocks have kind of sold off here over the last couple of days.
Yeah, I thought that was, it certainly put a smile on my face, because when I first saw the markets reacting, I really did think, what is that all about? And then it started to dawn on me that maybe they didn't get what was in that statement.
That's absolutely right. And look, let's do a bit of clarification just for everybody listening right now, is that the reason that we raise interest rates is because we want to slow economic growth, which quells inflationary pressures. So if the economy, if the Fed truly believes that the economy is growing at a rate rapid enough to cause spiraling inflationary pressures, then what you want to do is raise interest rates to slow that so that you can put those inflationary pressures under control. But the economy grew at 1.59% in all of 2016. In the first quarter of 2017, the Atlanta Fed came out the same day as the Fed hiked rates and says, well, the first quarter is looking to be about 0.9%. And when we dig down below the headline inflation data, the only thing going up in inflation is rent costs, healthcare costs, and energy costs because of the rise in oil prices. Everything else is flat to down. And rent and healthcare extract capital from consumers to consume items with, which is what makes the economy grow. So the Fed is walking themselves into the same trap they did in 1999 and the same one they walked into in 2007, thinking that the headline economic data was what was really happening within the economy.
Yeah, the number that jumped out, or the aspect that has been jumping out at me, is that the consumer seems to be slowing down a little bit. The consumer in the States is just such a huge component part of the economic growth. And as you say, that number, under 1% in the first quarter, I kind of say, what the heck is all the thought about that you've got a strong economy in the States?
Well, exactly. Well, look, okay, so you hit a good point here. In the U.S. economy, the consumer, what you and I and other people buy from Amazon and whatever else, that's 70%. That's roughly about 70% of economic growth. The rest is imports and exports, government spending, private investment. That makes up the other 30%. So this whole fallacy is always thrown around as like, well, corporations will pick up where consumers slack off. No, that's not true. What corporations do is they respond to the demand from the other 70%. So if 70% is slowing down, corporations slow down as well. That's why fixed investment is about to go negative on a year-over-year basis. Real wage growth is negative for 2 months in a row. Industrial production, the actual output of what companies are manufacturing, has been negative for 24 months. That is the longest stretch outside of a recession at any point in history.
Let me come back to, so the markets, obviously, as you said, were positive on Wednesday, but let's take the bigger picture. They've been positive really since Mr. Trump's election. Is this all about anticipation of what changes he's going to make, whether it's the infrastructure spending or especially the tax side of things?
Absolutely. And here's an important point about this, though, is that consumer expectations are very, very high right now. But what's happening in the economy, in other words, what consumers are actually doing is, hey, I'm going to wait and see what happens. The question now becomes, with Donald Trump now wrapped up in Congress in terms of, this kind of snafu on his immigration orders, this debate going on with his Obamacare repeal and replace, which is pushing out any type of tax reform. We just hit our budget debt ceiling on Wednesday. Nobody's even talking about that at the point, but we've now got to raise the debt ceiling in order to issue more debt because on June the 1st, we run out of quote-unquote extraordinary measures to fund spending in the government. So there's a question as to how long that investors and consumers will wait to see action that may not even occur now until late this year or even early next year. One other little fact here. cutting taxes, reducing spending, increasing, trying to do tax repatriation, all these type of things, infrastructure spending. We've done all these things in the past, but everybody compares Trump back to Reagan when Reagan did the big tax cuts. The difference is that when Reagan was in office, we were running at 5 times earnings. We had inflation and interest rates running in double digits, which were on the decline, versus today where we've got valuations at 29 times earnings and interest rates and inflation near zero. You have the exact opposite environment, which means that any type of benefit from tax cuts to corporate earnings, et cetera, are going to be grossly limited to where they were back in 1985.
So I'm going to take a break right now, Lance, just because I don't want to interrupt the subject. Because I want to come back and say, okay, what are the implications for, the stock market, implications for the bond market at this point, and maybe some lessons that people can take away from this. So we'll come back and do that. Lance Roberts, my guest. Great stuff. And by the way, I'm going to tell you where you can get. If you just go to realinvestmentadvice.com, Lance writes a daily blog there, and it's great stuff to keep you up to date on what's going on in the markets. It's realinvestmentadvice.com with Clarity Financial. Back in a moment with Lance Roberts. I've got a shocking stat for you coming up. I've got Aussie Jurek, and live from the trading desk, Victor Adair will join me just before the Goofy Award. Right now, though, very pleased to welcome back to our show Lance Roberts. He's the chief editor of the Real Investment Report and economist for Clarity Financial. Lance, just before the break, you were sort of outlining what the state of the economy was, which wasn't really coinciding with the sort of bullish statement, at least, that Janet Yellen made, in light of her Fed raising the rate, saying the economy looks just good and things are moving ahead. But I want to break it down and get into the markets for a second. Let me start with the bond market because, rising interest rates, the bond market certainly reflected that compared to what it was doing, say, in July of this past year. Where do you stand on the bond market right now?
Well, let me just back up real quick for you, just for everybody listening, is that first of all, I am not bearish on the stock market. Right now, our portfolios are fully invested on our long equity side. We did take some profits a couple of weeks ago before we went into this Fed announcement, expecting a little bit of a pullback and correction here. Our bond portfolios, we've been adding aggressively to those ever since last week when interest rates got up to 2.6%. We've been aggressively going out and buying fixed income for portfolios. Of course, we saw a nice reversion post the Fed rate hike as interest rates went from 2.6 to 2.5. So that was a nice little pickup in fixed income. I've been writing about every week for the last, really since January, about this underlying rotation within the market from the risk-on sectors. Remember, right after Trump was elected, financials, basic materials, industrials, remember the Trump trade, those sectors went shooting off to the moon. Everything else kind of went in the other direction. In January, I started writing about the fact we were starting to buy all the stuff that nobody wanted. And since then, there's been a very nice rotation in terms of performance as those unwanted sectors have now come up nicely in value, while a lot of the Trump trade sectors have faded in terms of momentum. So, we're always looking for the opportunities within the market. But I just want everybody to understand is that short term, the markets are bullish. But what's happening right now economically, longer term, over the next 12 to 18 to 24 months, is not a healthy environment for investors and will likely lead to loss of capital within the next 24 months.
So back to what you've been doing yourself. So you remain invested in the market, but you changed sectors to do that. I'm just saying that as a sort of an outlook for individuals listening today, that someone can say, hey, I'm still in the market, but you have to ask which aspects are you? And so you obviously made a switch.
Yeah, I did. I went from being right after the election, we were long financials, industrials, and materials. Beginning in January, we rotated out of those. We still own those sectors. We just don't own as much of those sectors. And we started buying healthcare, utilities, staples, REITs, preferred stocks. Those have done very well since then. It's been a little bit of volatility, but we've had a nice return on those sectors. And I do expect with this debt ceiling hike that's here, along with the economic growth. I want to talk one thing about the economy real quick here. But with what's happening with real economic growth, what's happening underneath the surface, I do suspect that interest rates will be closer to 1.5% to 2% before we see 3%. And that's because of this historically large number of individuals that are now short the bond market. When something happens economically, whether it's a debt ceiling disruption or economic growth slowing more than expected, When money starts flowing back into bonds, that huge short position in bonds is going to cause interest rates to go down sharply, bond prices to come up. So I'm looking more on that side from an exceptional rotation trade more than simply just I like bonds because they pay an income stream right now. I think there's a good capital appreciation play in bonds right now.
Let me just go back to something you've mentioned. Just because we're going to start, as you said, we're not hearing about the debt ceiling issue particularly at this point. There's not very much on it, but we're going to be hearing a lot more about it. So I'm going to ask you just to sort of outline that again for our listeners, so when they do start hearing about it as we get closer to probably June 1st, they'll know all about it.
Sure. Well, you'll remember back in 2011, we had the debt ceiling debate here in the United States, and that was where there is a limit. There's a statutory limit to the amount of bonds that the U.S. Treasury can sell in order to raise revenue to pay for the deficit that we have between what we collect in terms of revenues and what we spend on a monthly basis. Well, when we got to the debt limit back in 2011, the ceiling was hit, and we had to go through the debt ceiling negotiation. Normally, we just raise it and we move on, but we got into this big debt ceiling debate between the Republicans and the Democrats. And remember, at that point, interest rates on bonds fell by 2% over the course of almost about a month. A big collapse in interest rates. There was a threat of debt downgrades from S&P, et cetera. And since then, we've had a couple other debt ceiling debates along the way. They've always raised the debt ceiling. I suspect they will do it again this time as well. But what could disturb the bond market is if we get, and the Democrats are wanting to do whatever they can to stymie Trump's success in the White House. So this is a prime opportunity for them to stand firm on not raising the debt ceiling. The closer we get to June the 1st, when we run out of actual capital to fund our spending, is going to start putting fears in the bond market. You're going to hear a lot of headlines about, the U.S. is going to default on their debt. We're not. We can print currency. We'll always pay our debt. But you're going to hear these in the headlines, and this is going to potentially roil the markets and put downward pressure on stock prices. So you don't want to dismiss this unless they just come in next week and just raise the debt ceiling. We all move on down the road. But it is something that could potentially cause volatility in the market, and it's worth paying attention to.
And as you alluded to just a few moments ago, is that one of the factors that makes you more confident in the shorter-term bond market as a play, that bond prices will rise? Besides short covering in the bond market, then this may add also impetus to the upside of bond prices, which brings interest rates down.
Yeah, well, exactly. If we get to another debt ceiling debate like we saw in 2011, you're talking about 0.5% to 1% on the 10-year Treasury.
Wow.
That's a huge capital appreciation if you own bonds. From 2.5 to say 0.5% to 1, that's a big appreciation.
Let me change gears just for a second and ask for a sector of the market that you're very familiar with. And I just don't want to run out of time before I've got your take on what's been going on. Speaking of changes, what's been going on in the oil market?
Yeah, well, I live here in Houston, so we're very near and dear to the terms of oil markets. While there's a lot of, talk about how oil prices are going to stabilize and we're going to normalize the market, we're nowhere near that right now. In fact, shale production's increasing. We've got a lot of drilling going out into the Permian Basin, which is primarily shale oil drilling. Right now, we just came off the longest, number of record contracts in terms of people being speculatively long crude oil prices, betting on higher crude prices. That's when we had that very sharp 9% drop last week, because we were unwinding a lot of those bets on oil prices, because the production in shale oil has now completely offset the entire production cut by Saudi Arabia. Saudi Arabia is not going to sit out of the production market forever. They are not going to lose market share long term. They're willing to do it short term to try to stabilize oil prices, but a break below $48 a barrel is going to trigger more of this reversion of this very long bet on oil prices. You could potentially see oil prices drop into the low 40s, and you're going to see, and this will particularly become more reticent if Saudi Arabia starts to increase their production to regain some market share. So this kind of stability that we had in January and February in oil prices, it was very strange, but we've likely come to the end of that. So expect to pick up in oil price volatility. Energy stocks have been under pressure. They're about to break their 200-day moving average. So I would be if I'm long oil, I'd be looking to lock in some profits in case we do break that 200-day moving average. And then I would also expect the problem for the S&P as a whole is that a lot of the increase in the employment numbers we've seen, a lot of the increase that we've seen in fixed investment has come from the oil sector. And if oil prices fall, that's going to impact earnings, the earnings recovery story, which has been primarily coming from the energy sector, and it's also going to impact the fixed investment and employment numbers as well. So you'll see a reversion there.
Lance Roberts is the editor-author of the Real Investment Report, and you can just go online and read it. Plus, he's got a daily blog there too. But just go to realinvestmentadvice.com. Realinvestmentadvice.com. You'll see Lance's picture there, by the way. Good-looking man. But also click on blog, click on newsletter there for the Real Investment Report, and the blog for his daily updates on that. So, Lance, let's summarize in very quick, sort of Barbara Walters-like fashion. And again, this is a generality, and I'm warning people, you all have your own specific circumstances, so you have to understand that. But broadly speaking, it sounds to me that you're still okay with the markets. You like the stock markets, rather. You like the bond markets, but I really love your point about the debt. The debt ceiling can certainly throw some action into these markets.
Absolutely. Well, first of all, everything we've talked about today, ironically, is what I'm actually writing about in this weekend's newsletter. So if they do go to the website, and just click the subscribe button, put your email address in at realinvestmentadvice.com. I will email you the newsletter later on this afternoon, so you'll have it. But I'm talking specifically about the Fed rate hike, the impact to the markets, the 10 risks to the markets right now that I'm watching. It's all in there. So everything we're talking about here is actually in the newsletter this weekend. But importantly, to your point, is that yes, I like the markets near term, but I'm invested in the market. So you and me talking about why the markets are going to go up is irrelevant. We're already in the market. Your listeners are already in the market. What we need to be paying attention to are the things that are going to potentially take away capital from us, and potentially a large amount of capital. We are pulling into the 9th year of this market, historically long by any measure, and we have every ingredient that has ever been available to any major market top throughout history, whether it was 1973, 2000, 2007, the same exact ingredients exist today that existed then, that all led to major market corrections. So this is certainly not a market that you want to ignore and just say, hey, I'm going to be a passive investor and buy and hold. Because
we've got to hold it at that, Lance. We got to stop it there. We got Lance Roberts. Thanks so much. Go to realinvestmentadvice.com. You can get all of that in the new newsletter with Lance Roberts.